So Acrisure, first of all, as we get into this and give you an update and background, how many people before today, or before reading the program or hearing John Wepler or somebody mention it, how many people had heard of Acrisure before today? Not many hands. So that doesn't surprise me, and as I go through our model and I talk about who we are and what we do and how we built the company, I'm a little surprised that the hands that we even raised were raised. So the story of Acrisure, as Beverly mentioned, I co-founded it in 2005. My background, and I won't bore you with all the gory details other than it is relevant because a comment John Wepler made earlier is so true, rings so true to me, in that in the 80s I was a banker, working in the banking industry, not as a commercial banker, but I had some P&L responsibility. I did that for about 9 years, and I'm a little slow, so it took me 9 years to figure out banking and entrepreneurial really don't go together. Or entrepreneurialism don't go together. So in 1990, I left banking, started a sales and marketing company that was in the telecom industry, had contracts with 2 Fortune 500 firms, and really in the telecom industry, the thing that attracted me to that was it was entrepreneurial, had high recurring revenue, high profit margins, low capex requirements. Does any of that sound familiar to you? So there was also a legislatively created opportunity that I knew at some point in time was going to legislatively be taken away. So it was 1990, start the company, ramp it up. We hired 40 people in 60 days. And when I say that, hired is a technical term, they were 1099s. And had an office in Chicago, Indianapolis, and Southeast Michigan. Ramped the business up, nice recurring revenue, profitable inside 40 days. So a great business model. Again, we knew it was going to be taken away at some point legislatively. So I started at 90, sold it in 93. The legislative correction came in 95, so I did get out at the right time. And really at that point in time, had some options and choices, so I decided to start an investment banking company. So I was running around the United States and Europe from 1993 to 2005, doing a lot of M&A activity, primarily with private equity funds. I mean, everybody has heard private equity mentioned a lot here today. So I was working with investment groups, private equity funds, and people of that nature. Learned a ton about M&A and also how they think and view industries, and did that from 93 to 2005, as I mentioned, having a lot of fun doing it. When I'm coaching my daughter's basketball team, and one of the girls on the team, her dad's an insurance guy. And so every practice, every game, every time I ran into Rick, he's saying, when are we going to sit down and talk about building an insurance broker business? I said, Rick, you're a lot of fun. Insurance just doesn't sound like that much fun to me. So I enjoy the time with you, but at the end of the day, it really doesn't sound like that much fun. So I've spent my life driving by these insurance broker businesses, never once thinking about a business opportunity, never once giving it any thought. And at the end of the day, Rick opened my eyes to the fact that, you know what, here's a really compelling business model, high recurring revenue, nice profit margins, low capex requirements, all the things that drew me to the telecom industry in 1990 to 1993. So it was an awakening, it was enlightening, and fortunately he stayed persistent and pestering me to pursue this. So in 2004, I ran around the country meeting with anybody and everybody I could meet with, doing diligence on the industry, and really just trying to understand. I could spell insurance at the time, but that's about it. But really wanted just to understand, what is this business opportunity that Rick's so excited about? Came away from that diligence effort with 2 things. The financial fundamentals of the industry are terrific. I think John Wepler called it the greatest industry in business. I would agree with him. It is. Demand, all the attributes we talked about, recurring revenue, high profit margins, low capex, all those things are true. Not prevalent in very many businesses, and where they are prevalent, demand is not what it is in this industry. So it is the best industry, and working with private equity funds across the country and in Europe, I will tell you, it's the best industry that I've looked at. So got very excited about the opportunity, sat down with Rick and advised a strategy and a plan that was going to be a point of differentiation in the marketplace. And so in May of 2005, we did our very first deal in East Lansing, Michigan, where I live. 78-year-old agency. 3rd generation was running the agency. 4th generation was working in the agency. And we decided that basically the model, because, and I think this is a unique difference between us and so many other companies that are private equity backed, because we are private equity backed, and I'll talk about that in a little bit, we're that today. But when we started the business, the first 16 deals that we did, I wrote a check. And I will tell you that when you're writing the check personally, it does change your view, it changes your perspective, and it changes your model. And for us, we wanted to find good businesses with good people, have a historical track record of success, owners that were not interested in selling and retiring, but owners that also wanted to be very entrepreneurial, stay in the business with some skin in the game. And when I say that, have ownership still, because we were looking to essentially find entrepreneurs that we could partner with. And so the model was good businesses, good people, align interest, etc. But then as an investor, not turn investing into gambling by changing a lot of things in the business that we already knew was working. So our model in 2005, it's the same model today. We don't change the name. We don't brand Acrisure. That's one of the reasons I asked who's heard of Acrisure. We don't brand Acrisure. We don't change producers' compensation. We don't change management. We don't close this office and move it into another location. We evaluate the business for how it operates today, and it either works or it doesn't. So what we found and what we believed at the time, and I think that we'll talk about some facts and some statistics in a minute, what we found was that model resonates with entrepreneurs. People who are looking to, and I love John Wepler's chart earlier, I think it was sell it, milk it, or grow it, I think was the, so our approach is, you know what, sell it and grow it is a combination that actually is there in our model. And part of that is, yes, there's an opportunity to transact and build some value and create some, monetize some value that's been created, but also by being an owner still, and in this case being an owner in Acrisure, they're still very entrepreneurial, and as we grow the business, they get to benefit from that growth as well. So I'll talk about scale and what that's done for some of our partners. And we do, and actually we have an agency partner I didn't know was attending, but Greg Stone's in the back. We do refer to them as agency partners. The relationship is not an employer-employee, it's a partnership. And there's a big difference in that model versus just about anything else that's out there. So that's our approach. That's what makes us unique. Again, we started in May of 2005, built the company up to about $38 million of revenue in 3 states, Michigan, Indiana, and Illinois. Built the company up to $38 million of revenue and $10 million of EBITDA. Still no private equity involved. The business was essentially a handful of investors. So we had a very nice business that we could have milked, to use John's earlier phrase. We could have milked for a long time. A great business in the Midwest, and again, we're Midwest guys. So it was actually something that was very attractive. The more attractive option is we thought we had a compelling business model and something that we could go out and take to the marketplace that would resonate. And really, so we're at that inflection point. Keep what we've got and just continue operating it, or build it. And so we decided to build the business on a national scale. Went out and raised private equity capital with Genstar Capital out of San Francisco. We closed with Genstar in March of 2013. And did our first deal out of the Midwest in July of 2013. And to this day, so from July of 2013 to present day, so just a little over 2 years, actually the 78 transactions that Beverly was mentioning, those 78 transactions have been done in the last 2 years. So we've actually done a little over 100 deals overall. Now, one of the reasons that you haven't heard of us is a part of our model is when we talk about producers' compensation and account executive compensation, we don't change it. The reason that we don't is that, from my standpoint, from day one, I've said, look, as soon as you take the people that are touching your clients and you impact them in a negative way, bad things are going to happen. So that's why we don't do it. Finding situations that didn't work out in the industry where, company A bought company B, and 3 years later, half the producers left, or a number of producers left, or there was fallout. Finding those situations is actually quite easy. And again, for the guy who was writing the check for the first 16 deals, I didn't want to add risk to my investment. So the kind of the investment thesis and the model for us was quite simple. Find good businesses and not change what they're doing, and then find ways to help them grow. And in the early days, that was probably a promise that, it's not that we didn't mean it, we meant it, but we really didn't have much to offer them. Today, we have a lot to offer an agency that becomes part of Acrisure and our agency partners. So, bringing this full circle, $38 million of revenue, $10 million of EBITDA in July of 2013. Today is $400 million of revenue and $140 million of EBITDA. So we've grown revenue 10.5 times in the last 2 years, and we've grown our EBITDA 14 times in the last 2 years. So it's a model that's resonated well. The 3 states have become 24 states. And by the way, it sounds like this is just an inorganic or acquisition growth strategy. It is. But we also have, and what we take a lot of pride in, is organic growth. Now, it's going to pale to some of the numbers John was showing earlier, but we grew 7.3% last year organically. We're growing year-to-date 5.4% this year, thus far. So on now a $400 million company, 5% doesn't sound like a lot, but it's over $20 million of net new growth. So it is something, and if you compare it to the kind of the public peers and the other private equity backed, it's kind of hitting the threshold we want from a performance perspective. So as you look at the profile of Acrisure, those are some of the things we're hitting or that we've accomplished and achieved in the last couple of years. Probably, besides organic growth, and this kind of speaks to the organic growth, the thing that we're really proud of is that agencies that get involved with Acrisure and our partners that get involved with Acrisure, 1 year after the transaction, their EBITDA, their revenue's grown 6.1% on average, and their EBITDA's grown 9.9%. So the evidence of, or the proof of, or the importance or significance of that is essentially we are helping our agency partners grow. As they become part of Acrisure, we are bringing resources, we're bringing technology, we're bringing a lot of things that they didn't have because they just simply couldn't afford them. And we are bringing those things to help our agency partners grow. So it's a data point and something that we point to as we're out talking to people all the time, is that you're going to grow with us. And as a result of that, I'll paint you a little bit of picture. And while I say that, John's sell it, milk it, grow it, to me, there is a sell it, grow it option here. Is we just did a deal 6 months ago now, 5 months ago, where the 3 owners of the business were 35, 35, and 50 years old. And one of the 35-year-olds, his father was the CEO of a pretty good-sized insurance company. That Auto Owners is the company that some of you certainly do business with. So as we're talking to this 35-year-old president, he said, "All right, Greg, this is compelling. I'm interested in doing this, but I need to go talk to my dad." I said, "All right, Dad's going to kill this thing for sure, no question." He went and talked to his dad and sat down and went through the whole thing with him, the whole story with him. And his dad, in fact, told him, "You know what, you should jump on this train because these guys are going to help you grow in ways you can't do on your own." And as a shareholder, when you're going from $38 million of revenue to $400 million of revenue in 2 years and $10 million of EBITDA to $140 million of EBITDA in 2 years, there's no way to create that kind of growth on your own. You're just not going to create that kind of shareholder value. So as 35-year-olds, and I'll talk about our future in a little bit, as 35-year-olds, they have the opportunity for the stock component, which is typically about 15 to 20% of the transaction, 15 on average. The stock component will be far greater in value than they took out in cash. At 35 years old, they know that. So it's a compelling opportunity from a diversity of assets perspective, in terms of taking what you have in value today, growing it without it all being on the burden and the backs of yourself and your own efforts and your employees, et cetera. So there's some help that we can provide. So as you look at kind of the growth of the company, if since inception we've grown 80% on a compounded annual growth rate from a revenue, 85% on an EBITDA perspective, with the bulk of that being in the last 2 years. We started this year with a $207 million of revenue. We'll end this year with $400 million of revenue. And again, in a business model where day-to-day life really has not changed. As Greg Stone in the back can share with you, we didn't change. In fact, Greg wanted to change the name of his company to Acrisure. We didn't let him. So you didn't know that was going to get used, Greg, but true story, right? So at the end of the day, it is something that we believe we want to minimize impact on the business. We want to minimize impact on clients. The best way to do that is don't change the brand, don't change producers' compensation, and basically focus on things that we can bring to the business. We're not big into integration. We're not big in consolidation. I'd rather focus on revenue growth rather than moving chairs around in the back room somewhere administratively so that people can, find efficiencies and things of that nature. So that 9.9% EBITDA growth is really not with expense reductions, it's with revenue growth primarily. So if you look at our history, and by the way, I'm very cognizant of the fact that this was a 3:45 start. Everybody's been here all day. And when I got the schedule and said, okay, great, it's 3:45 and I'm after a break. So my 17 slides I've condensed to 7. So hopefully people appreciate that a little bit. So what I call the turbo date was 3/1/13. That's when we partnered with Genstar. So we're going to, Midwest company is going to become a national company. That's the focus. And everybody gets excited about, okay, we've got capital to spend, we've got a business model that works, that we've proven it from 2005 to 2012. Everybody's very excited about what all that means. The challenge is, and this is where some of the industry experience outside of the insurance industry comes into play, is that I knew at the end of the day that there was much more here than just going out and being a good investor and being smart about where we spend money. That's the big part of the story, and you better do that right. But really, in the home office, if you will, once you're out now growing the company, if you're growing anything 10 times in 2 years, there's challenges that come with that. There's operational challenges that come with that. Some of it's resources, some of it's people in terms of adding more than what you have already. But really, even those, when you're adding those resources, understanding how the business is going to operate, the decisions that are going to get made, who's going to make those decisions, and how's that all going to really work. And so I sat down with my executive team, which is 6 people, 7 counting me, and the next layer of people that get involved with agency partners. So it's 26 in total. And we sat down back in March of 2013 and said, okay guys, life's got to change, because if we're successful in growing this business, we're not going to be able to operate this thing the way we've always operated it. So yes, going out and spending money, that's relatively easy. But making this work, and I don't know if I mentioned earlier, we do have a 36% EBITDA margin. So to give you a frame of reference, so John was referencing 30% margins earlier. We're sitting here with a 36% margin on $400 million of revenue. So it's something that we have done quite well. But as you look at the decision-making process and how you operate the company and where the decisions are made are important. And so I knew I was going to be on the road constantly. And so things that were always brought to me, I knew could not be brought to me anymore. So we really had to rely on people stepping up, and we had to empower people in a different way, in a way that we hadn't empowered them before. So as you look at building with a financial sponsor versus managing without an investor, the focus obviously is external as opposed to internal. Communication is going to be sporadic and electronic, not frequent and personal. I'm on the road 5 days a week. Take 1 week of vacation a year. Maybe a sad statement about my life, and I wish my wife wasn't here when I said that, but at the end of the day, that whole, the communication was going to change. It's going to have to change. Decision making, high level, distributed, personal authority required as opposed to central, participative, and less autonomy. We're going to have to empower people to make decisions, help our agency partners when they have questions, and if everyone's relying on calling me, there's only so many hours in the day, there's only so many emails I can answer, only so many phone calls I can take. So we're going to have to take an entire roster, of this case 26 people, and really say, look, we're paying you to make decisions. You've got to make decisions. If you make the wrong one in terms of helping an agency partner with something, then we'll correct it later. But we can't punish you for it. We've got to empower you to do it, because it's the only way you're going to grow a business tenfold is if you have that kind of decision making pushed down into the organization and really empower people. And again, we did this back in March of 2013 when we hadn't invested a dollar yet and we hadn't grown anything. We're still 38 million and 10 million of EBITDA. Change profile, we said, look, if we're successful, this is going to be a change a minute. High frequency of change as opposed to something that was intentionally slow. Our $38 million business that was operating just fine, we didn't want a whole lot of things to change. Well, in this environment today, things are changing constantly. The pace, it's a sprint versus a marathon. Private equity-backed folks that are in the room or can share is that there's a time horizon that they're investing in. Typically it's 5 years. They're looking for a return on investment in that 5-year window. And so having a marathon or even a middle distance type of pace is not really something that's going to work. And if you're not accustomed to it or you don't know what I mean, I'd be happy to talk to you later. I mean, it is the clock is ticking every day, and you got to make progress every day. There's a reason we've done 78 transactions in the last 2 years. I mean, we're not, there's no grass growing under our feet here. So the skill set of paramount importance became time management. When you're growing 10 times, obviously you've got a lot of things in terms of demands on your time. Time management, assertive decision making, not by me, not by my management team, but really the next layer down. They're going to have to be adept at understanding the model, knowing how we're going to interact with agency partners always, and as they make decisions, making sure that's consistent with all the things that we're doing. And then communication obviously is always important. And that's the translation, or the opposite of that is what it used to be, which is we were execution oriented and communication oriented. So you hear a lot about the spending of money. You hear a lot about the pace of growth. You hear a lot about those things, but I would tell you, as you're part of a growing company like this, and you have an investor or sponsor or somebody of that nature that has these expectations, I threw this in here because I would tell you it is a big thing that never gets talked about, never gets any airtime, but it's absolutely critical in terms of how do you grow a company and do it successfully and maintain a 36% margin. These are the kinds of things that are important to us. So if you look at our objectives, we said back in March of 2013, we're going to be the top 10% of overall growth. We're going to be the top 10% of organic growth. We're going to be top 10% in the EBITDA margin. That's compared to the public peers and the PE-sponsored companies. As Beverly mentioned, I don't know whether it's true or not. Business Insurance is reporting this next month we're the fastest growing in the United States for the last 2 years. I don't know whether it's true. They're saying it's true, so I'm going to use it and say it's true. So we've achieved that. Organic growth, the 7.3 this year, if you compare that to the same group, we would be in the top 10%. And the 5.4% is maybe close, I'm not sure, obviously time will tell. And an EBITDA margin of 36%, that is the highest of our peers in terms of what we've achieved. And so the combination, and there are, I'll say the secret to the sauce, there are things that are key to having the growth rate that we have, having the organic growth rate that we have, and maintaining a high margin. That's kind of the secret to the sauce that I'm not going to get into and share, because it's really, that is the one thing that really differentiates us. But there are specific strategies that we've employed to make sure that we've maintained those kinds of performances. So the future, same thing in 2005 is true as today. We're looking for good companies with great people and great partnerships. The alignment of interest is huge. We get together twice a year with all of our agency partners, March and October, and it's 2 years ago there were 7 people in the room, and this October we're meeting in Dallas. Ironically enough, there's going to be about 140 people in the room. These are owners, shareholders. They work together, they cross-sell, they're leveraging their strengths across the network, and that's why we're achieving the organic growth that we have. And so it is a very collaborative process, and people, gender sensitivity and all that being what it is, people have described it as a band of brothers, and then there are, females in the room too. But they've described the camaraderie and the esprit de corps as a band of brothers, and it really is, because they're all linked together through that ownership and that commonality of interest in terms of how to grow the business, and by growing the business, is it benefiting them and their other partners, and that has all happened and achieved, and it's been great. So in terms of the future, we talk internally about being a no limits company. Drives GenStar nuts, and Ryan Clark was going to be here from GenStar, and fortunately he's not, because he acknowledges drives him nuts. So they ask me every year, Greg, what's your goals? I said, Ryan, I really don't have any goals. He said, well, we've got to have a goal. I said, well, I really don't have a goal. And the reason that I answered that, and I'm so ambivalent about it, is that at the end of the day, we just run as hard as we can run, squeeze the most we can out of every single day, and whatever the results are, they are. We're going to live with them. Because if I'd done and kind of subscribed to that theory and that thinking, I could have told them we want to grow 20% this year, but no one in their right mind would think 200 million of revenue become 400 million of revenue in 12 months. But it's because we have this no limits attitude, this no limits approach to our business and how we grow it. As Beverly said, we work too hard and too many hours and all those things. But that is our culture. That's how we, it's who we look for. It's the people we look to align with. And so I would tell you that absolutely drives the business in terms of the growth. It's how 200 million becomes 400 million, because no one in their right mind would think that that's possible. And it drives GenStar nuts too. So the last thing I'll leave you before I'll open up if there are any questions. So GenStar is a private equity group. Today they own, when we closed with them in March of 2013, they owned 80% of the company. Today they own 47% of the company. 53% of the company is owned by the agency partners and the management team. So we flipped kind of the model, and in the PE world, David North and others were talking about 7 PE funds and all of that. It's an unheard of statistic to have a PE group that's got the kind of money invested that GenStar does to have minority shareholder interest. But today they're a minority shareholder. Now we will trade, because GenStar's an investor. They're going to do what investors do. They'll trade in the next couple of years. Not a thing to be scared of, and internally we talk about it all the time. Not a thing to be scared of. That's a good thing, because it gives everybody the opportunity to monetize value. And then roll equity if you want to roll equity going forward. Well, with 53% of the equity being owned by the agency partners and the management team, there's an awful lot of people that want to roll this thing going forward. The momentum, even though it sounds like it's not, how could it possibly pick up or go from where it is today? It's actually increasing as Acrisure story and the operating model and how friendly it is with entrepreneurs and the value that's being created by people personally, etc. It's actually now picking up. One of the reasons you don't hear and haven't heard about Acrisure, most of you in the room, is we don't do press releases. And the reason is, I know that, again, that drives some people nuts, but we'll do 50 transactions this year, 50 this year, so almost one a week. Lots of transactions, lots of values being created by people. We actually closed 2 deals literally today, one in Houston and one in Philadelphia. And it's something that we just don't want to talk about and publicize, because again, it gets back to, as soon as you do something in terms of an announcement, this is my perspective and my opinion, I know it's counter to everybody else's, but at the end of the day, an announcement that somebody traded is typically not viewed as a good thing by a client. In fact, they'll question whether leadership's changing, whether people are retiring, what's going on. Certainly something's going to change because you just sold. So we just don't talk about it publicly. So I'll go back to 2005, the first transaction we did. We closed. I'm at the closing table with Chuck Levy. 10 years later, Chuck's still there. And Chuck said to me, he said, "Greg, you're going to issue a press release, right?" I said, "Chuck, I really hadn't thought about it, but now you mentioned it, let's talk about it." So we did down the proverbial down the center down the line, a piece of paper, and pros and cons. Pros for doing a press release, we literally couldn't come up with one. And finally Chuck said, "Well, Greg, wouldn't it make you feel good?" I said, "Well, yeah, for about 10 seconds it made me feel good, but Chuck, that's a personal reason, not a business reason." Reasons for not doing press release was actually quite long. Confuse clients, wave the red flag to your competition, all those things that we all know that happen. And so we just said, "All right, Chuck, forget it, we're not going to do it." I called Chuck 1 week after closing. I said, "Chuck, how's it going?" He said, "All right." He said, "Greg," he says, "other than my bank account and the money that's in the bank account," he says, "it's like the transaction didn't happen. Schindberg Insurance is still Schindberg Insurance. All our people are still here. They're getting paid what they were getting paid. Clients don't know anything, et cetera, et cetera." He says, "It's like the transaction didn't happen." That's our model. And we've done that now over 100 times in 10 years. We've had a lot of fun doing it. We still like to be kind of the best kept secret, going, and hopefully whether we're invited back next year or not, we'll hopefully have another year where we're growing a couple $100 million in revenue and another $75, $80 million of EBITDA. So back to our no limits. That's kind of philosophically who we are and what we're doing. And appreciate the opportunity to come in and kind of share the story today.